Hello, everyone. I'm Haydn Zeis, your host, and I want to welcome you to the Raising Returns Real Estate Podcast. Our main goal is to provide you with real information and ideas that are going to help you boost your investing career. Now, whether you want to be a passive or active real estate investor, I can guarantee you that you're going to learn something new on this show. Today's guest is Chris Watson, the owner of New Leaf Financial, and he has extensive background in personal finance. His company takes a comprehensive approach and they help people achieve their financial independence. Chris is actually my financial advisor, and he works with my insurance and stock investment accounts. And now you might wonder why we have a stockbroker coming onto the show, but I truly believe that if you're a full-time investor in real estate or a part-time investor, no matter what, it's definitely important to diversify into stocks. And now they both have their pros and cons, but it's absolutely important to diversify in both. So let's just jump right into it. Chris, thanks so much for being here.
Yeah, happy to be here. Thanks for the invite.
Hey man, so tell us a little bit about yourself, how you ended up getting to where you are in finance.
Yeah, no doubt. So got into the industry right out of college, graduated in 2008. Didn't really have a career path in mind, but I had an economics and business degree. So '08 was an interesting time to go into the workforce, but it was a blessing for me because I ended up kind of job shadowing a few people, decided I wanted to get into the financial service industry, and 11 years later, here I am. I set up New Leaf in September of 2013, and that was really due to the fact that I wanted to be more of a holistic planner. So I wanted to kind of have a lot of different options in play, be able to take a holistic approach with people and make sure they're evenly balanced in regards to where they're putting their money. And so, again, launched in 2013, and here I am about 7 years later.
When you said you started in 2008, that's interesting because that's obviously the financial crisis that was kind of real estate was the center of that. Now we're going into some turbulent times right now with COVID-19 and the stock market's going up and down pretty erratically. What challenges are you seeing out there, and what are you telling your investors, and I guess how do you see things playing out?
Yeah, so to kind of relate it back to 2008, even though in the moment when I got started it seemed like the worst time, it honestly was a great time because it kind of gave me a perspective in regards to how bad things can be. And so fast forward 11 years, here we are, COVID-19 is in the forefront. It's kind of a good way to say, look, we know this has happened before. We know that just by default, the market's always going to go up and down. That's just kind of how the game is played. And so because we could look back to '08 and kind of use that as a benchmark in regards to what the market could do, we're able to kind of make better decisions today. And in addition to just the stock market, it was kind of a good reason for me to learn early on, you got to have multiple asset classes in your portfolio. So the market isn't just going to be the end-all, be-all. You got to build out around it. For times like this specifically.
Well, I think that's one of the things that people look at and they worry, hey, the stock market's dropping, but there's only a few individuals that really need to pay attention to it, and those are the ones that are getting closer to retirement, and that's when they should sit down and talk to their advisor or talk to whoever has their money. I mean, for us, we try to do as many communications as we can with our investors to keep them on the
Right.
forefront of what we think is happening. That's one of the things that going into stocks versus real estate, one of the things with real estate is, real estate's a tangible asset and it acts as a hedge against inflation. And before the show, you and I were talking about, what might happen if $2 trillion goes into the market. What kind of inflation are we going to see? But the same can be said for stocks. You've got stocks that are liquid, and that makes it a little bit easier to move it around when you need to.
Yeah, no doubt. And so, again, back to '08, we kind of saw a lot of things come to light in regards to how the financial industry was played, so to speak. And now 11 years later, a lot of those restrictions that we put in force in regards to mortgages and how much money you could borrow, et cetera, are still in force today, which is a good thing. This turbulent time is really just due to something we've never seen before. So, by putting a stimulus package in place, we're really just trying to kind of weather the storm as best we can, keep people, with cash, with the ability to pay their bills and their debt obligations. And, hopefully if it does sort of die down or kind of level itself out, we'll be able to get back up and running with, the service industry, vacations, the airline industry, things like that. But in the meantime, there's got to be a solution in regards to kind of how we get through the 30, 60, or 90 days that, we're trying to get everybody off the streets and just kind of bunker down in their homes.
Well, I think what's going to end up happening is we're going to see once businesses start opening back up, once people are back on the streets, you'll see a very large influx of consumers going to the businesses that they've been missing for the past 30 days. So I think that,
right.
It'll be really nice to see restaurants full again and retailers that are not considered essential full again. And I think that what's different between this recession and past recessions are we know exactly why the market just popped. It's because of COVID-19 and a lot of the other,
right.
Recessions, depressions, we weren't necessarily sure what was going on until 6 months down the road.
Right. Yeah, and two, the big buzzword right now is recession. And by definition, that is 2 quarters of negative GDP. So if we look at COVID-19, the decline really started at the end of February. So, we're only about 30 days into this, give or take. And the end of quarter one is technically not until the end of March. So we're still kind of waiting to see where we fall over the next week and a half. After that, we get into quarter two. So from April 1st to the end of June, that's going to be, the second quarter of the year, which at this point is looking like it's not going to be too good. We have yet to see that, but from everybody's projections, that's probably not going to be the best quarter we've seen. So, technically we could say if quarter one is down, even though it's been down over the last 30, or it would have only been down over the last 30 days, roll into quarter two, that's down, then yes, we could definitely define this as a recession. But again, we still kind of have to see what happens in Q2, and then going into Q3, depending on how the stimulus package plays out and how quickly we get back up and running, that'll determine what Q3 and Q4 look like. So I think, too, like to your point, we are just uncertain in regards of what's going to happen, but we do kind of have a nice look back in comparison, which would be 2008. And we're not really at those levels yet, although, again, we still need to see what plays out over the next couple months.
Well, and I think, what a lot of people should be looking at is looking at this as an opportunity. This isn't a time to worry. This is a time to look for bargains. And, right now, like I was telling you before the show, I've started looking at real estate that has just been put up for sale within the last 2 weeks and looking for bargains. Why is that seller selling? Could it be that they're over leveraged and they need to get rid of an asset? Could it be that they were doing a flip and they need to turn this turnkey rental very quickly? The same can be said for stocks, and you and I were talking about this about a week ago. When the bottom comes, you're going to start getting calls for people to throw cash into their brokerage accounts so they can buy cheap.
Yeah, absolutely. So that's the best point is you got to take this as an opportunity. And so there's 2 things with that. One, it's an opportunity to buy in with cash because it is on sale, the market specifically, compared to what it was 30 days ago. But 2, it's an opportunity to kind of take a step back and evaluate everything that you've got in place. So if you entered into the workforce around the time I did, you really haven't seen anything but positive returns from about 2009
yeah.
on. So if you woke up, 2 weeks ago and looked at your 401k balance and said, oh man, this just totally dropped by 15 or 20%, whatever the number was at the time, it kind of makes you sit back and go, well, here's the 2 positives. One, I'm still employed. I'm still working, so money's going into my 401k or whatever my investment account is if you're actively contributing. 2, I realize this is a possibility that the market can go down. So if I sit back and say, look, I've got about 25, 30, 35 years of work life still remaining, this is a great time for me to realize there's got to be other options for me to take my money and apply it towards outside of just the stock market. So a lot of the conversations I've been having with clients or potential clients is, look, we know you've got X amount of dollars committed to the market. It's going to win about 75% of the time. However, about 25% of the time, it's not going to win. So, yes, it is an opportunity to buy in, but two, it's also a good time to evaluate what other asset classes are out there. Which real estate is another asset class that they can take a peek at and say, how does this mold into my portfolio? And that's kind of going back to the initial thing of me wanting to be more of a holistic planner and kind of taking a look at all options. I'm happy to entertain those discussions and kind of help people make those decisions based on how they think it can benefit them.
Well, I think that's why you and I mesh so well, is because you do understand real estate, you understand the value of it, and you understand the pros. And, I'm the same way. I understand the pros and cons of real estate investing, and I know the pros and cons of the stock market. But now, we will get past this, and that will hopefully happen sooner than later. And once things start to level out, can you kind of give some examples of maybe how you would work with a client to talk to them about how stocks and real estate can both together create a solid foundation for somebody that's maybe before retirement and then when they're ready to retire?
Yeah. So the big question I always get from people is, where should I put my money? Right. Well, take a step back and first kind of define, based on your income, how much of your income are you saving? So what are you actually paying yourself with first, and then what are you paying everybody else with based on your income? And regardless of age, the goal is to save about 20 to 25% of whatever you make. So if you make $100,000, $20,000 to $25,000 is what you should look to pay yourself with first. And then obviously taxes and lifestyle is going to come out of the remaining balance. So once we've decided, hey, we can save that 20 or 25%, now we just need to decide where do we put it. And, we go through the list of what are your options. Number one for most people is their company retirement plan, whether that's a pension, whether that's a 401k or a TSP, something to that effect. That's probably going to get a piece of it because your employer 9 times out of 10 is going to match. So we say, okay, you get a 5% match. Let's put 5% into that plan. Now we have to sit back and go, well, where do we go with the other 15%? After that, I'm a big fan of saying, look, why don't you build up your emergency fund? So for times like this, or for times when your car breaks down, or something happens with your home, whatever your situation is, you've got some money to kind of weather the storm. And once you get that built up to, say, 3 to 6 months of lifestyle or living expenses, we can redirect any sort of a surplus to other asset classes. So that's kind of where real estate could come in. That's a good asset class by definition because it keeps up with inflation, and it's not directly correlated with the stock market. You could kind of argue back and forth, yes, it is, but and it does kind of mimic, I guess, what the market does. If the market declines for a long period of time, home prices or property values will decline. But there are some plays out there where you can still see, rents are being paid, companies are still paying their rent, tenants are still paying their rent. So depending on how much leverage you have into that property, it should still be hopefully a cash flowing vehicle for you even in times like this. And if we say, okay, real estate, does make sense, well, where do I go? Well, you can go buy properties in the residential market and rent them out to tenants, be the landlord yourself. You can go buy commercial properties, rent them out to businesses, again, being the tenant, or you can kind of invest in a fund that does that property management for you. They find the properties, they lease them up, they pay the bills, they take care of all the maintenance, and then depending on how the fund works, you're going to get a piece or a return of whatever that cash flow looks like. So again, it's kind of just saying, look, and my biggest thing to people is make sure you build a foundation first. So I would very much say, look, why don't you get your reserves built up? Why don't you get a solid foundation of kind of steady Eddie things in place, and then look to do some things that maybe have a little more responsibility tied to them, as opposed to just going in guns blazing to maybe things you're not really ready for. And then if a time like this happens, either you're over leveraged and don't have the ability to pay the bank and or pay whoever you're in debt to. And at that point, you're kind of at a position of, well, we just got to ride this out and hopefully it works. But my biggest thing is try to get a good foundation set up so you don't expose yourself in tough times.
Yeah, I think getting a foundation, you can't just go into a real estate investment without that foundation. You have to have some sort of understanding. And that's, like I said earlier, this is the reason that we started this podcast. It's to give passive and active investors alike an idea and just different tools to put into the tool belt to go out and get their first investment. And I always suggest that people talk to their financial advisor, they talk to their real estate agent, they just talk to as many different people as you can. Try to get a mentor. These people are people that want to help educate you and want to be able to see you grow. And everybody wants to see you succeed. And if they don't, they're just a bad person. So,
right.
So
yeah, it's the me before we mentality if they don't really care how you end up.
No, and I think that's something that can be said for shows like this, and just the different coaches that I've run into that have wanted to help me. You're a real estate investor as well, and you have some investments. Could you maybe talk about those types and what attracted you to them?
Sure. So for me, I didn't get into real estate until I was about 30 years old, and I started as an advisor at about 23. So, I didn't jump in right away, which you could maybe say that's good or bad. For me, I was just kind of really focused on building my business primarily and, kind of getting my legs underneath me, if you will. So with that being said, it took me a little bit of time to get into it. And I will say, too, that's a good thing, or at least for me it was, because I didn't really understand real estate right out of college. I mean, yes, I understood you could live in a house and you could buy things and sell them, but I didn't really understand the fundamentals. One, how much you had to put down. Two, what a mortgage felt like. But as you get older, you kind of get into those things by default. So I'm taking a long way to answer your question, but
No.
Until I bought my first house and then said, oh, okay, now I know what a mortgage feels like. You put this amount down. Here's how real estate taxes work. Here's how, keeping up with a home looks. Here's how the mortgage doesn't feel as intimidating as I thought it would, because I have however many years you choose to pay it back. Then I kind of got, okay, I can palate this a little more, and it doesn't feel as overwhelming to me. So, fortunately, I've had some good, to your point, advisors in the real estate world who have been able to explain it to me, in addition to some research I've done on my own, which led me to two things. One, I own a commercial property that has a commercial tenant, so it's a triple net lease. I'll let you kind of dive into all those specifics, but basically the renter, they're triple netted. So they're going to pay the insurance, they're going to pay the real estate taxes, they're going to pay the rent, and then I'm in charge of paying the bank back and doing the property management and maintenance. But what drew me to that was some close advisors that kind of said, look, I think this is a good purchase. I think we can get a good tenant in here. You've got other positions that aren't going to over leverage you. So let's take a look at this. And eventually we ended up buying the property. So for me, it was nice because it was a diversifier. It was something outside of the stock market and some of the insurance products that I own. So it gave me kind of that third asset class that I had been looking for. So that was kind of one thing that appealed to me. The second thing was, over the long term, once the bank gets paid off, whatever that tenant is paying is going to come to me via the cash flow. And I'm making a little bit of cash flow on it right now, but ultimately once the bank note goes away, which is still about 16 years out, then all of that income just directly funnels to me. Mm-hmm. So that was appealing. Outside of that, there's like Haydn, we've worked with funds that you can get involved with. And again, I'll let you kind of explain how the fund works, but what appealed to me was, again, it was a diversifier because I didn't have to manage the property. So for me, I've got kind of a busier week and I want to have a life outside of just work. So to tackle something like this, again, seemed a little overwhelming, but what I did like about how the fund works is I didn't have to buy, 100% of the property. I could buy in with other investors, yet still have ownership. It's passive income, so assuming everything works and the tenants are paying their bills, bank's happy, there's going to be some excess cash that gets returned to me as an investor, which I like. And again, it's not me being on the hook for 100% of the responsibility. It's kind of sharing in very little responsibility, but sharing in some of the profits based on how the property cash flows. So long-winded answer, but I kind of like having both angles in play, one from an active management, which gave me better understanding as to how it worked, and two, passive management, which gives me the income, yet still allows me to participate in the fund.
Right. Yeah. I think, both types of investing, especially the triple net property that you mentioned, although it is active, it is more passive in nature than maybe a multifamily or just a single family house. And then the fund, from the fund's perspective, like you were saying, the risk is spread out among all of the investors, but you're also being able to buy into something that you might not necessarily have been able to purchase on your own. And, in this instance, you've got 4 different properties that you're invested in, and they are very diversified. So that limits risk as well. And you're not responsible for the leverage. You are responsible for only that down payment that you're putting in, or that cash that you're putting into the fund. So, that's something that limits risk in a way. And like you said, allows you're a busy professional, busy throughout the week. So you're able to go out and do the things that you want to do without having to worry about the investment and worry about getting that 2 a.m. phone call. But I think this is kind of a good segue into, maybe margin loans and how margin loans can be used to diversify into real estate. And I'd love for you to talk a little bit about that and explain that to the listeners, because, this is one of the best ways that an investor can take advantage of the cash they have in the stock market and go and buy real estate.
Yep. Yeah, before I touch on the margin loan, let me go back real quick to your point about affordability of commercial real estate or just rental real estate in general. From an affordability standpoint, it's not as cheap as your primary house. Like with your primary house, it's a lot cheaper to buy because, or I shouldn't say cheaper to buy, it's a lot easier to get into because you have a lower threshold of down payment. When you're doing a commercial property, you have to put a lot more money down out of pocket. So kind of to your point, Haydn, you can share with other investors getting bigger properties because you don't have to come out of pocket as much, as opposed to if you try to find your own commercial property, it may just be unaffordable because you got to come out with most banks 20 to 25% down, maybe more than that, just to get into that property. So yeah, I wanted to clarify.
No, that's a great point. Yeah.
Kind of how that works. And then two, when you actively manage a place, as great as it is when there is a tenant, triple net, not to gloss over the fact that there can be a time where that tenant moves out and you have a vacancy, the bank still requires a payment. So definitely keep in mind there is some downside if you lose a tenant and have some vacancy for an extended period of time. But outside of that, there's definitely a lot of appeal to both, depending on how active you want to be with it. So anyway, segue into the margin loan. So I will kind of put this disclaimer out there. It depends on what type of investment account you have in regards to how much money you can essentially borrow against. So brokerage accounts are, with most lenders, what they want you to have in order to offer a margin loan. And say you have a $100,000 brokerage account. Most lenders will let you get at least 50%, maybe a little more, give or take. But essentially it works kind of like a line of credit against those securities. So when you talk about leveraging it, you definitely want to sit down, talk to a few different people, maybe a CPA, obviously your investment advisor, somebody with experience in how this works, and make sure it's the right fit for you to want to use a margin loan to purchase real estate. And then if you do decide to use a margin loan, make sure you understand what the payback is on that loan, and make sure you understand, depending on what type of property you invest in, how that payback can work. So that's just a big disclaimer to really make sure you know what you're getting into. I would definitely talk to somebody with experience, high experience in that market, because you don't want to get into a situation where you think you understand how it works, and then all of a sudden COVID pops up or some other sort of unforeseen event happens and you're exposed in a way that you don't want to be. But yeah, to kind of drill down on some of the basics, it depends on what type of investment account it is, and it depends on the lender in regards to how much you can borrow or put on margin in regards to that account.
Well, I think what's beautiful about it is you might take a margin loan out for $1 million, and rather than that $1 million sitting in the stock market making 6%, you can leverage that maybe at 50% and put $500,000 as a down payment onto a piece of property, and then you're still earning that money and that interest off of that $1 million that's in the stock market, but you're able to leverage that a $500,000 loan that you took out and put it into commercial real estate and increase your cash on cash return. So overall, what's beautiful about it is you're making money from two different investments, but you still have that $1 million in the stock market earning.
Yeah, you're totally right. Yeah, and so the first response I gave was definitely the disclaimer of kind of buyer beware, make sure you know what you're doing. However, once you get that down and you have that level of comfort by using it, that's exactly right. You can create multiple asset classes based on what you've already got established. So the thought of it is, anytime you want to kind of expand your wealth or grow your wealth, you want to get as many assets in place as you possibly can. So if you can have a stock portfolio that allows you to create additional capital to buy other assets, which then in turn will give you cash flow or a heightened rate of return, over time, or if you do a flip right away, yes, you can still keep the stock market account in play and growing if the stocks perform. But in addition to that, without any money out of your bank account or your own pocket, you're leveraging that asset class to create another asset class via real estate or whatever you try to get into. So it's again using the leverage or other people's money to create additional assets for yourself. That way, over time, you're getting compound interest and you're getting accelerated growth with money that you've already essentially put aside for the future. So it's a great way to kind of get leverage and duplicate what you've already been diligent in saving and investing in.
Well, the thing that I want to point out and to your disclaimers is this is not a type of investment you'd want to take as a beginner. You'd want to work closely with your financial advisor and real estate advisor to tackle something like this. But one of the best things about real estate is when you use leverage responsibly, you can boost your returns exponentially. So leverage is great, but if you use it, if you're over leveraged and a time hits like COVID-19, for instance, then you might be in a little bit of trouble. So I think using leverage, and I've said this on other shows before, but using leverage responsibly is one of the best ways to, boost your returns. But I guess, wrapping things up, I've got one last question for you. And, Chris, that would be from an investor perspective, what advice would you give the listeners to raise their returns?
Yeah. So first piece of advice would be definitely try to hit that 20 to 25%. And the reason I say that is if you can get that cadence down of paying yourself, that's huge. Because if you look at just the savings percentage across the U.S., it's very low. It hovers right around 5%. So the average income earner is saving about 5% of what they make and then spending 95%. So if you can save 20 to 25 and put it in a balanced investment portfolio, some sort of vehicle or product or property that's going to return whatever the return is over time, by default you've raised your return because you've saved money. That's the first step. Secondly, if you can kind of build the foundation and say, look, I know I've got money for long-term, which is going to be my 401k. That's my long-term investment account. I've got mid-term money, which could be a brokerage account, a rental property. There's some insurance products out there that kind of act as that middle return account or middle term return account. That'll give you a secondary kind of layer of returns now, but also returns for the future, depending on if you access them or not. And then thirdly, if you can say, look, once I've got these vehicles in place and I can learn how to leverage these vehicles to create other vehicles, that's going to be able to kind of rapidly increase however many assets you acquire. So not to be hopefully too indifferent on what your question was. I guess to summarize it, it would just be to save first, because by default you're going to increase your returns the better you get at saving as opposed to spending your money. 2, being able to put them in vehicles that will appreciate over time. Stock market, like I said, wins 75% of the time. Real estate will win the majority of the time, as long as you get into the right property for the right price and find good tenants, which over time you should. Yes, you will have some ups and downs with both the market and with the real estate market, but that's just kind of how it is. You can't go 100% for everything you try to do. And thirdly, don't try to be a perfectionist on everything. Just make sure that you're understanding as much as you can and surrounding yourself with good people who you trust, and kind of like Haydn said, have your best interest at the forefront, and everything else should kind of just take care of itself with time.
Well, Chris, I think that was well said. I really appreciate it. And man, thank you so much for being on the show. And I am sure we got to grab a beer once COVID-19 lockdown loosens up.